In this video, we'll unveil the secrets of supply and demand trading, the only strategy you'll ever need to master the markets. So, supply and demand trading is a strategy that focuses on identifying price levels where there's a significant imbalance between buyers and sellers. This imbalance creates what we call supply and demand zones on your charts. In the market, there are always two competing forces: buyers, who represent demand, and sellers, who represent supply. When there are more buyers than sellers at a certain price level, it creates a demand zone. When there are more sellers than buyers at a price level, it forms a supply zone. In these zones, you often see large unfilled orders from big institutional traders like banks and hedge funds. Supply and demand trading is powerful because it allows you to trade in line with what the institutions are doing. These big players can't hide their massive orders, and by identifying supply and demand zones, retail traders like us can spot where they are likely to be executing their trades. Let's talk about how supply and demand actually influence the prices you see on your charts. You see, the price is constantly moving up and down, and this movement is a direct result of the supply and demand from market participants. When there are more buyers in the market, they bring demand, and this applies upward pressure on prices, pushing them higher. When there are more sellers, they bring more supply to the market, putting downward pressure on prices and pushing them lower. This dynamic between buyers and sellers is what we call order flow, and it's the engine that actually drives price action and market movement. Now, there are two main types of orders that make up this order flow: passive orders and aggressive orders. Passive orders are limit orders placed by traders who are willing to wait for the price to come to their desired level. They are not in a rush to get in. Aggressive orders are placed by traders who want to execute immediately at the current market price. They are not waiting around for a specific price. They want in, fast. This constant battle between passive and aggressive orders is really what causes those explosive price movements you see on your charts when there's a significant imbalance between supply and demand. So your job is to identify where major imbalances are likely to occur. So why are institutions so interested in supply and demand zones? It all comes down to the massive size of their orders. Institutions like hedge funds and investment banks are trading huge positions that can be worth millions or even billions of dollars. And when you're dealing with that kind of volume, you can't just enter or exit a trade all at once. Imagine trying to buy $1 billion worth of a stock without moving the price. It's just not possible. There's simply not enough liquidity in the market to absorb an order that large. So instead, institutions have to carefully pick their spots and look for areas where they can gradually build or unwind a position over time with minimal impact on the price. And that's where supply and demand zones come into play. Now let's break down how to actually identify them on your charts. The first step is to look for those explosive movements where price makes a strong push in one direction before quickly reversing. This could be a sharp rally followed by a sudden drop, or a steep decline followed by a rapid bounce back. These movements often signal that there was a significant imbalance between buyers and sellers that caused price to spike. Once you've spotted one of these big moves, the next step is to mark out the origin of that move. In other words, the area on your chart where that explosive rally or decline actually started. This is going to be your potential supply or demand zone. Now, there are a few different types of zones to look out for. First ones are base zones or range zones. This form when price is consolidating in a tight range for an extended period of time before finally breaking out. You can think of the edges of that range as areas of supply and demand, where a lot of orders have built up. So when price revisits those levels after a breakout, there's a higher probability of a reaction. We can also have pivot zones. This form at key turning points in the market, like swing highs and lows, or where you see price making a sudden change in direction. They're often marked by 1 or 2 candlesticks with distinct characteristics. For a potential demand zone, you want to look for a strong bearish candle where the next candle closes back above its high, signaling a shift from selling pressure to buying pressure. For a supply zone, you're watching for a strong bullish candle where the next candle closes below its low, indicating a shift from buying to selling. The key is that these pivots are happening quickly. Price isn't spending much time in these areas before reversing. To identify fresh zones, you also want to pay attention to the overall structure of the price action. There are 2 main types of structures to look for: continuation and reversal. A continuation structure forms when there's an existing trend in place, and price is just pulling back or correcting against that trend before continuing in the same direction. These are your rally-based rally and drop-based drop patterns. If it's an uptrend, you'll see a strong rally, a tight range where price forms a small base, and then another rally continuing the uptrend. For a downtrend, you'll see a sharp drop, a base, and then another drop, resuming the downtrend. Reversal structures form when price is reversing from one trend direction to the other. These are your drop-based rally and rally-based drop patterns. So in an uptrend that's starting to lose steam, you might see price drop into a base and then launch into a new rally, marking the start of a reversal. And in a downtrend that's starting to turn around, you'd see a rally, a base, and then a strong drop, signaling the beginning of a new uptrend. Now let's talk about the key principles that make this strategy so effective. The first thing to understand is that supply and demand zones are not just random levels on your charts. They are areas where the imbalance between buyers and sellers is most extreme. When you see explosive price movements like huge rallies or steep drops, that's often a sign that there was a serious mismatch between the amount of buying and selling pressure. What's happening in these situations is that the aggressive orders from one side are rapidly consuming all the available orders from the other side until a new equilibrium is found. The areas on your charts where these big clashes take place are what we call fresh, unmitigated supply and demand zones. One of the key things that separates these high probability zones from ordinary support and resistance levels is the amount of time price spends in the zone. You see, when there's a major imbalance between buyers and sellers, the price won't hang around that area for very long. It will quickly spike up or down. So when you're analyzing your charts, one of the things to look for is zones where the price only spent a short amount of time before making a strong move in either direction. The less time price spends in that area, the more out of balance supply and demand are, and the higher the probability of a successful trade when the price returns to that zone. Another key principle is to focus on fresh, unmitigated zones, rather than ones that have already been tested multiple times. When price revisits a zone, it can absorb some of the pending orders that were sitting there, making the imbalance less extreme. So as a general rule, the more times a zone has been hit, the weaker it becomes. This is why it's so important to understand the difference between an unmitigated zone and one that's already been tested a few times, a mitigated one. The trading opportunities are very different. Now, of course, there are times when a zone can remain valid even after being tested, if there is still a significant order imbalance. But generally, you want to prioritize fresh zones when planning your trades. So the key things to look for are zones that form after explosive price movements, zones where price only spends a short amount of time before spiking up or down, and fresh zones that haven't been tested or absorbed by the market yet. Now let's talk about how to validate whether a zone is likely to hold. The first thing you want to look for is a clear break of structure. This means price needs to make a decisive move away from the zone and take out any nearby swing highs or lows. If there's no clear break of structure and price just hovers around the zone, that's a sign that the zone might not be as strong as it seems. Another key concept is the idea of flip zones. This is when a previous supply zone turns into a demand zone, or vice versa. For example, let's say you have a strong supply zone that's been holding price down for a while, but then suddenly price rips through that level and closes above it. That's a pretty good indication that the zone has flipped from supply to demand and could now act as a support level for future pullbacks. But here's the thing. In order for a flip zone to be valid, you need to see that initial interaction between the two forces. Don't just assume a zone has flipped because price moved past it. Look for that clear battle between buyers and sellers and wait for one side to decisively overpower the other. Another important factor to consider is inducement. This refers to the presence of liquidity in front of the zone that could potentially absorb any move against it. For example, if you're looking at a demand zone, you want to see some buy orders stacked up in front of that level. This could be in the form of a swing low or a consolidation pattern, anything that suggests there are traders waiting to buy at that price. If there's no liquidity in front of the zone and price just slams into it, chances are those big players aren't going to be too interested in getting involved. But if there are orders they can trade against, they're much more likely to step in and defend the level. Of course, even if a zone checks all these boxes, it's not guaranteed to hold forever. That's why it's also important to look at how fresh the zone is. In general, zones that have been tested multiple times are less likely to produce strong reactions than those that are being hit for the first time. Now let's talk about the difference between supply and demand zones and traditional support and resistance levels. While they are similar concepts, there are some key distinctions. First off, support and resistance are levels where price has previously reversed or consolidated multiple times in the past. Supply and demand zones, on the other hand, are all about fresh, unmitigated levels. Rather than focusing on areas that have already been touched multiple times, these zones represent imbalances between buyers and sellers that have just recently formed. The key difference is that support and resistance trading relies on the assumption that past levels will continue to hold in the future, whereas supply and demand trading looks for new, untested zones where the order flow is likely to be more significant. Remember this, support and resistance levels are essentially supply and demand zones that have already been confirmed. Once a fresh demand zone gets tested and holds, it then becomes an established support level. The same goes for supply zones. They become resistance after they've been touched. So while trading support and resistance can certainly be effective, especially if a level has proven itself multiple times in the past, the probability of a reaction tends to diminish with each subsequent test. This is why you should focus on fresh zones, where the initial imbalance between buyers and sellers is likely to be the most significant. Now let's talk about some specific entry and exit strategies you can use around these key levels. One of the simplest and most effective ways to enter a trade is to simply set a limit order directly on the level itself. This approach assumes that the zone will hold and that price will reverse once it hits your order. However, there are a couple of potential downsides to this aggressive strategy. If you set your order too far away from the zone, you might miss out on the trade entirely if price never quite reaches your price. Or the second scenario, price might just break through your zone with ease. A more conservative approach is to wait for a specific candlestick pattern to form at a level before entering a trade. For example, you might look for a bullish reversal pattern, like a pin bar or an engulfing candle at a demand zone. The idea behind this strategy is that these candlestick formations can give you a bit more confirmation that the zone is likely to hold and that price is getting ready to reverse. Another technique you can use to fine-tune your entries is to look for specific structures on lower time frames. For example, let's say you've identified a strong demand zone on the 1-hour chart, but you want to get more precise with your entry. Instead of just buying blindly at a level, you could drop down to the 15-minute chart and look for a reversal pattern, like a double bottom, or a change of character to form at the zone. In this way, you can often get a tighter entry with a better risk-to-reward ratio. Now, let's talk about how to evaluate the strength of a supply or demand zone. One of the first things to look at is how quickly price moves away from the zone after it's formed. Generally speaking, the faster price shoots away from a level, the stronger that level is likely to be. Quick and significant moves away from a zone indicate a strong imbalance. So if you see price just rocketing away from a zone, that's a pretty good sign that there is some serious order flow happening there, and that institutions are likely defending the level aggressively. Another factor to consider is the amount of time price spends at the zone before making that initial move. The less time price hangs out at a level, the more likely it is to be a key turning point in the market. So if you see price just kind of dip into a demand zone and then immediately start rallying higher, that's often a signal that big buyers have stepped in and are absorbing all the available supply. The actual size of the move is important too. Obviously, if price barely budges after hitting a supply or demand level, that's not exactly a big endorsement of its strength. But if you see an extended move in the opposite direction after a zone is tested, that's a sign that the level is probably pretty significant. Another thing to watch for is the volume during the formation of the zone. Generally speaking, you want to see a noticeable uptick in volume as price is testing a key level. This indicates that there's a lot of interest and activity happening at that specific price, and that institutions are likely absorbing or distributing there. Another factor that can affect the strength of a zone is whether or not it causes a break of market structure. A supply or demand zone that causes a break of structure is generally stronger. It takes a significant amount of money to break market structure, making the zones more likely to hold in the future. So if you see a zone forms and then price just starts trending in the opposite direction and breaking through key levels on the chart, that's often a sign that there is some serious institutional backing behind the move, and that the zone is likely to be a key focal point going forward. Now, let's talk about some of the most frequent mistakes that traders make when it comes to supply and demand, and how you can avoid them. One of the biggest errors is trading from a weak structure. This often happens when traders zoom in too much on their charts and lose sight of the bigger picture. They might see a high that failed to break the previous one and think it's a good supply zone to short. But if the overall trend is actually bullish, they're likely to get smashed trading against that dominant direction. So always consider the broader context before entering a trade. It's crucial to align your trades with the current order flow. Traders also tend to have the wrong expectations of how far price will move after hitting a supply or demand zone. Old mitigated demand zones often become reaction points for pullbacks rather than areas for new highs, especially when order flow turns bearish. So if you're expecting a full trend reversal from an area that's already been tested multiple times, you might end up disappointed. It's also a frequent mistake to trade from zones with no inducement. Inducement refers to the liquidity that's available in front of a zone. If there's no structural low or other liquidity built up in front of a demand zone, that means the only available liquidity is behind the low itself. That lack of inducement makes the zone more prone to failure. So always check where the orders are stacked in relation to your zone. Now, if you want to take an even deeper dive into some of the strategies we've touched on here, be sure to check out these next videos.